All right. Good morning, everybody. Little something new that I had been doing for a while. I just had not been publishing anywhere. If you are on the OEC website, you can see where I have this little widget that mentions the morning briefing. I haven't had a chance to break this page out of that yet, but it has a little button that says here. And if you click on the here, it takes you to another page where I do a little bit of a market summary, a little bit of a look back on what happened in the previous week, and then a look forward on expectations for the new week. There's always a date on it so that you'll know the last time I made any changes to it. I get busy and sometimes I don't get it updated. So I'm not going to go through what I wrote. You can do that, take your time later on and go through it. It's always a little bit different each time. It might have SPX levels or ES levels, or it might not. It just changes. The Fed speakers are no longer in blackout mode, so they have been out there chipping their teeth and providing their insight and input into the public space. So far, it's like that Madagascar cartoon where they say, if you have any poo, fling it now. It'd be a good time for someone to throw poo at them. They're just saying the same thing over and over again, not providing any real insight and just muddying the waters. But that's the way it is. We're getting closer to the midterm elections being done, which should directly affect crude and energy and oil and gas and the whole space. But what we're going to be seeing this morning is that there already is an effect going on there from other influences, and it's certainly something to keep an eye on when it comes to inflation. Energy is a direct component of that, right? And if the Fed in any way at all believes that they've been getting some sort of grip on inflation and that it's trending downwards, well, the energy costs have been manipulated by the White House for elections, and that's nothing against this current president or this current administration. Every single president does this. So, I'm not throwing shade on this president or any other one. It's a tactic that is used. With the holidays coming, we generally see a rise in fuel costs. When the White House Strategic Petroleum Release program ends, we're going to also see a rise in fuel costs. And it's just on and on. We have CPI this week, so it's important to kind of keep that in the forefront of your mind. If you're wondering how impactful CPI can be, the orange and yellow lines is where we had CPI reports. And as you can see, CPI reports can be just as volatile as an FOMC report. So, that's on the agenda this week. We got CPI this week, and then we have PPI next week. We do have additional auctions today at 11:30. They're really the only things on the docket today that I'm really paying attention to. The other ones, of course, that they have impact, but consumer credit is at 3. I'll already be done trading at that point. I don't like trading into power hour. So any anticipated impact from that, is just gonna be past me. But the 11:30 auctions are very often where we spot those midday reversals, where a trending market can just stop trending completely and stay range bound the rest of the day, or a range bound market can suddenly break out and begin trending. The size of the weekly expected move is slightly smaller than last week. We talked about this on Friday. The thing is, on Friday in the morning, when I do the morning briefing, the box is not yet locked. It can still move all through the day on Friday. And so we have to look at it again on Monday and see, how much more it changed. And you can see the gray box that I just drew is the range from last week. And the new week is smaller than that. Not massively smaller, but still smaller. And it seems like the market makers just kind of looked right past the CPI. It is what it is. It's on the table, and our day-to-day moves are nearly as big as the whole expected move is. And there's plenty of reasons for that, but basically volatility tools are broken right now and they haven't been fixed. It's worth noting that the swing low took us up to the swing high, which swung us over for the swing low. What I wanted to point out, though, are the times where we don't reciprocate and we actually get blocked, right? And for a lot of the year, those blocks were coming in when we would rally up into that white line from below, that linear regression line. But it isn't always from below, right? Back in August, when we rolled over and we had the mic drop Jackson Hole moment, and we continued that move to the downside, we actually made contact with that linear regression and rebounded back off of it instead of continuing the sweep. We did finally get down there and complete the sweep from one side to the other. It just took a little longer, and we had to back up and get a running start. Right now, the sweeps have been much smaller, right? We're kind of, we're slowing down in that swing high, swing low. If we were to put on a sine wave, right, you can use that from your drawing tools. The peak to trough is getting narrower. And last week, it looks like we might have kind of gotten blocked a little bit. So we could get another retest across that 3,900 area, or even just somewhere close to it before we continue the wave or the rollover. And the rollover isn't guaranteed, right? There's no assurances that we're not going to just rally up and break above 3,900, but that would be odd. That would be an unusual situation. It shouldn't go that way, but with CPI and PPI, it's certainly possible, right? We never want to say that price can't do something. It would just be very unusual to see such a thing, right? But we know that it happens. Say, for an example, back here, where we just kind of got tangled up in it and around it, and price really struggled before it finally made the move onto the other side. So, and in that instance, back here, we actually were getting, lower lows and equal lows. So if we were to flip everything over, there is, the possibility that we could get equal highs or even higher highs in a wick, right? We wouldn't expect, you know, a full-blown breakout, but we are barely back above the 10-week. And I mean, just, you know, wink and a nod, we're there. It doesn't have to stick. It doesn't owe us anything. We're still underneath the 10-week, however. So we're barely above the 10-day. We're still below the 10-week. We are inside day at the moment. Consider where we closed on Friday, the size of Friday's range. We're still sitting inside of Friday's price action. The expectation is that we could possibly wick out of the top of Friday, but there's no real expectation of a follow through to the upside today, at least not yet. I'm going to mention it. I don't really know what to do about it or what the cause was, but the ADSPD, the ADNDD, the tick, and the CTIC Friday were not working very well. Just like missing data points. No idea what was going on with that. The NYSE clearly was showing, but there was no NASDAQ, no Russell 2000, and the advancing minus the declining issues, literally the market symbol that you would type in, right? It just, the data was missing. I don't know any other way to say it. It might have been a thinkorswim issue. I can't say, you know, for sure that it wasn't a thinkorswim issue. Looking back at it now, at some point over the weekend, it looks like they filled in the data, but there was missing data points throughout the morning. Yeah, here it goes from 947, 948, 949, and then poof, 1118. So some of the breadth indicators just weren't working. And since I don't know what caused it, I don't know if they fixed it. It's something to keep your eye on this week to see, you know, if our tools are doing what they're supposed to be doing. So it's worth noting that we are back inside the box again. It's the same box that we've been working on since late September. That little bit of a move that we had out of the box around Halloween didn't stick. We didn't really have much expectation that it was going to stick. And right now, 3820 is a line in the sand, a critical pivot point that I would lean towards today, or even through the week, that we might run up, we might touch it, even could wick through it, but I have no real expectation that we're going to close above it, at least until CPI comes out. If CPI comes out in a favorable way, and right now we're still in the realm of bad news is going to make the market rally and good news is going to make the market fall. So if CPI is, you know, indicating that the US is struggling, that would be bad. The market would like it, we'd go up. So we could retest and break out after CPI, but before then, I just don't see it on the table. All right, volume is a little light, not enough to be concerned, not enough to bring doubt or anything like that. And that's all we need out of this thing, so we just turn it off. We're struggling to get through the weekly pivot point. When we're above it, we're bullish, and when we're below it, we're bearish. We are below it, but we've been trending up to it all morning or all night, depending on how you want to look at it. So, that implies that we're trying to go through a transition from bearish to bullish. And if you look at where last week's weekly expected or a weekly pivot point is way up here, right? And we were below it Thursday and Friday. Now we're in a new week. The pivot point is lower and the market is struggling to get above it. It lines up really close with Friday's high. So, it's not an extra pivot that you really need to mark. Just keep track of Friday's high. If we break out with an inside day breakout today, that would be the 50% point in a retrace fib. We would be above the weekly pivot and we would be outside of Friday's range. So those are like check marks for bullish bias. We are above the daily pivot and expanding beyond it, which means you could use like R1, R2, R3 sort of things if you're into it. I'm not really into them, but hey, you do you. All right, we got a 10-day, 30-minute volume profile with a TPO. These shallow areas are really not all that shallow, but they are what we have. Point of control is 38.40 with our line in the sand at 38.20. Until we resolve CPI, I don't think that point of control is on the table. But if we happen to get through 320 and are pushing to the upside, that would be the gravity point that I would focus on, 38.43. Otherwise, when we're at the bottom of the box, we expect to go to the top. When we're at the top of the box, we expect to go to the bottom. And we came off of the bottom of the box, so the expectation is that we're moving towards the top. TPO and volume profiles, point of control, are lined up perfectly. So there's no divergence there to focus on. And the TPO is almost a classic B shape, whereas, and it's pretty ugly, the ES is more of a P, right? You got B and capital letter P, lowercase b, and then of course capital D for the way profiles form. This isn't much of a P, but is what it is. We do have a VPOC 38.48. There'll be a first touch play anticipated if we get there. If we start moving towards it and we get a little too close, it will become a gravity point. We have another one below us at 36.04. That's not necessarily on the table at this point. We don't have much expectation of breaking down significantly. any more than we have an expectation of breaking up significantly. I think the market's going to kind of hold the line and wait for the data. Something worth mentioning, though, is I was talking to a trader last week who focuses a lot on just the indexes: SPY, SPX, ES futures, QQQ, right? The indexes. And they were mentioning how difficult it was to trade Thursday and Friday through all of this trash. And when I asked them about, say, the monsters of tech, trading Apple, Amazon, Google, Tesla, Microsoft, Meta, whose charts had really nice price action and some really great moves, they said they hadn't even looked at them. So, you know, just a reminder that there's more than just the indexes out there to trade. And if the chart you're looking at isn't giving you opportunities, go trade something else. Hey, I like trading futures, but I don't consider every day and a great opportunity to trade them. The previous week's low is at 3,700. And it ties up with Thursday's low. I mean, that Thursday's where we got the low of last week. So that's going to be sort of our base case argument. 50% retrace. 3,700 on the bottom, 3,800 on the top. It's a 100-point move. We could wick outside on either side of the lines without any real expectation that it's going to stick, and that the market's just going to continue to wait with bated breath until we get the CPI. That's the base case argument. Along the way, if something should break, then of course, everything gets thrown out the window. I was listening to an analyst talk this morning about gold and how we had bonds this morning moving to the upside. We had gold this morning moving to the upside, and we had equities moving to the upside. And he said, something's wrong here. One of these three are lying, at least one, if not two. And that you want to be looking for a decouple between these three. One of them is going to go the other direction. Now, as I mentioned before, Bitcoin has been a little bit of an early tell when it comes to sentiment. It's not necessarily this idea that, oh, well, Bitcoin's down, so I'm going to short the market. No. But it gets my attention when I see Bitcoin down and the rest of the market up, because it has been an early warning of sentiment, negativity, positivity. The dollar is down this morning, which is not necessarily a bad thing at all. It's a part of the reciprocation process that we're seeing with the S&P moving higher, the NASDAQ moving higher. Oil's a part of the problem right now. Like I mentioned earlier with CPI, with the inflation expectations rising. There's a lot of different things that connect with the reason that we're seeing oil or crude go higher. One of those I wrote about is US dollar China. That was a significant move to the downside Friday. We saw the ramifications of that in the dollar. We also seen US dollar Canada. When it comes to FX pairs, they're very often a proxy for something else, right? Like US dollar China is a great proxy for commodities. US dollar Canada is a great proxy for energy or crude. On Friday, we've seen agriculture explode higher, massive gap up. We've seen energy, oil explode higher. Dollar down, Canada down, China down, Japan slightly down. Wasn't down as bad as the others. And we didn't really get anything out of it on the market side of things. That hard move in the dollar Friday should have given us an amazing move in the S&P and the NASDAQ. And it wasn't really there. Like fireworks that were a dud. A little bit of sparkle, but no bang. So you want to continue to watch US dollar Canada. No, excuse me, US dollar China, US dollar Japan. We're forming this really tight wedge. And the expectation is that we can't stay in the wedge. We're going to have to break out. There's no promise of direction in this breakout, just that a breakout is coming. And it will kind of ripple across the marketplace, right? Like throwing a stone in a calm lake and seeing the ripples out. The VIX is still broken. There's not a lot that we can do with it. Other than to point out that it's broken and that you really want to proceed with caution. I've been using the VIX futures, which, you know, hey, granted, they're not much better, but I feel that they're a little bit better. Without looking at US dollar China, you really wouldn't have an understanding of why the Dixie dropped so hard Friday. Right? I think most of us by now have gotten pretty comfortable watching the dollar on a day-to-day basis. And when we see the dollar going down, we kind of instinctively realize that's going to be helpful for the S&P and the rest of the market. But knowing why, or at least understanding why the dollar is falling, what's causing it to fall, kind of helps out a lot on how much we're willing to trust the move and how much we can expect it to affect other products. We really didn't get the follow through, but yeah, it is what it is. The good thing, though, on Friday was the rally was not, you know, too much of a surprise. So, you know, at least we had that. %45 of the S&P is up more than a half of a percentage point this morning. That's relatively bullish. Instinctively, I always look for financials in the S&P since we don't have financials in the NASDAQ 100. And I like to see if they're a part of the names or a part of the list that's up this morning, and they are. Of course, we have the monsters of tech this morning that are also up. I did close my Google trade Friday. It seemed like a good place to go ahead and get out. Looking back so far, I made a pretty good decision to get out. Just bringing the heat map, it makes this part a little bit easier to kind of grasp. All right, looking at the heat map and the S&P, I filtered it down to 100 names, and we're looking at pre-market change percent. I just changed the multiplier so that the colors would react sooner. The monsters of tech stand out. They're the biggest boxes. So Apple down 2%. There was news on that, right? Apple production numbers. And Costco's down 1.5%. Costco was a heck of a trade for the last few weeks, and now we're getting that kind of reverberation. Tesla more than 0.5% to the upside. So Microsoft, Google, Meta, NVIDIA. I mentioned NVIDIA in that briefing that I wrote up. This sector still continues to be a great sector to short, but that's become like a mantra that we hear everywhere, right? And after a while, it gets a little bit stale, and you got to kind of figure that there could be some, it's getting a little tired, right? So yeah, semis are still a great short, but we've got NVIDIA and a lot of the other chip names up this morning. AMD, more than 1%, Intel, so sure, semis are still a great short, and this looks like another great opportunity to sell the rip. I would just perhaps stress a little bit of caution, let it roll over. If this is going to be a new short for NVIDIA, and I do believe it's going to be, but for a new swing short, if we're right, and this is going to be a new short, let it actually make contact with that trend line, roll over, and begin going lower. Because if this is a new short, the target's going to be somewhere around $100, getting a new lower low than the previous low. So you don't have to get in it at the very top. Plus, with earnings on deck on the 16th, it just stress a little bit of caution. We've got a 200 period moving average directly over our head, but it's practically sideways. All right, so it's a weekly 200. Get above that, we got a weekly 20, slightly pointed downwards. A gap that needs filled. A descending 200, a long ways off the 172 area. This just looks like a new place to short it, but I would say let it report earnings or just look for some day trade opportunities until it does. Let this thing roll over, and then bigger picture. If we can get below the weekly 200 at 129, well, we'll call it 130. That would be a solid place to reshort. You can always short it off the highs if you want to, but just be ready to defend that if that's what you choose to do. One thing about Thinkorswim that kind of sucks is on the daily chart, you cannot see what's going on in the intraday until 9:30 and beyond that. So in the morning, when you're looking at, pre-market movers and all of that, the daily chart does not show you that movement. Now you can look at the really tiny writing up there where it has the bid ask, and you can see that we're down. We closed at 138.38, and this morning we're at 136. We'll split the difference and call it 136.90. So a trick to get around that is to set your chart to like 180 days or 320 days, whatever, something like that, and then put it on hourly. So it's 12 hours, 12-hour candles. They're not exactly a daily candle, but I mean, they're just close to a daily without being on a daily that you can get. And it is responding. You can see how it's reacting this morning, right? So it's kind of like looking at a live daily chart before 9:30. Right now, Apple is inside day, and it took a rejection off of that 3-period moving average, 3 or 4. Let's see. I think it's a 3. Either way, it's a very near, very short-term moving average. It's a part of the Surge series. Already this morning, Apple was down a lot more, and now it's rallied back up, but it's still sitting like IX10 between 138 and 134 half. Call it 133. It's a nice $5 move. So a break to the upside, look for Apple to aim at that 10-period moving average. And a break below that, should we begin going down. We got some levels to deal with. Kind of like stepping stones, right? You aim for one level, get there, see price resolve, aim for the next level. So 132, 129, 123, 118, and then 113. Likely not all done all at once, right? Be step by step. If Apple does try to make a run for it this morning to the upside, you really don't want to see it break out of Friday's range. Just in case, I don't think that we'll need it, but you never know. We don't want to say price can't do something. An upside move, we would target 144 half, 147, and then 151. We've got all these downward sloping moving averages that would be difficult to get through, to say the least. Now, finance is doing really good this morning, and this is often the divergence that we see between the NASDAQ and the S&P. Today's going to be a really big deal. One of the threats that I mentioned in that write-up is if we sync up, and that would be if we get our entire marketplace moving in the same direction, a high correlation coefficient. So watching the advance versus the decline, or just watching advancing issues, you're going to be wanting to look at something like a 97, 98, 99% correlation, that everything is moving in one single direction. So this is the S&P and everything looks great, but let's swap this over from the S&P to the NASDAQ. %44 of the NASDAQ is up at least 0.5% this morning. And that's kind of bullish. I mean, it's not aggressively bullish. There's no finance in here. So if it was only finance that was running this morning, it would stand out a lot. We wouldn't have this many names moving to the upside. But the names that stand out in here should be a cautionary tale. I've seen PDD and JD. Those are a part of the China ADRs. Remember, China told their state banks to start buying those companies. And so, you know, they don't have a choice. They've got to buy. And I see a lot of chip names: MU, NVIDIA, Texas Instruments. And AMD. So we want to be a little wary of a short covering rally this morning, or a short covering rally today. The idea that some of these names, for an example, Meta, has made significant moves to the downside in the last week or 2 weeks. As you can see here, we went from 127 down to 90. Google broke that 200 period moving average. It didn't even stop. It just ran right through it last week. And we caught a little bit of a rebound in that thing. NVIDIA has already started that kind of reflexive bounce back up. But the ones that are concerning are, say, Tesla, which is kind of holding the line right there, ready to go. This has not made a move like we just pointed out in Google, right? It hasn't had that yet. And Apple, for an example. Now, you know, with the news this morning, we can't see that on this weekly chart. But it's very likely we're going to be testing that lower trend line, and we're going to break that thing. Either one of those two, Apple or Tesla, have the strength or the capacity and the weight behind it to move this market. But then we would still be looking for that correlated market state, right? If it's just Apple or if it's just Tesla, it won't be enough. The expectation is that they would be enough to bring everything else with it. But that doesn't mean that it has to bring everything else with it. And that's what we want to be watching for. So the NY FANG, that's your monsters of tech. You could swap that out or add to it the XLK. So XLK, KRE, NY FANG. Want to watch these as we come into the open and see if we're actually going to get that correlated market state or not. Yeah, see, there's that gap in news where there just wasn't any data on Friday. Stopped printing there, started back up again over there. All right, so everything's on hold. We want CPI. Watch the dollar. If you continue to see moves in that thing, go directly to the pairs between, say, US dollar Japan, US dollar China, and see if what we're seeing in the dollar matches what we're seeing over there. This morning, for an example, we've broke below Friday's level, and we're making that move down in US dollar Japan, and we have the exact same setup in the US dollar, or, you know, in the Dixie. That's not the dollar index, right? if we continue to see this move down in the dollar, we're going to expect the S&P to break out and make that move towards 38.50. With the dollar, watch really close when we get back to 149.5. It's the pivot point from October 27. A break below that, and we could see the S&P and the NASDAQ, leg up above that 3,900 or the high of last month, so the October high. So that's what I got, everybody. Keep track of the projected Fed fund futures. They are unwinding a little bit. So we want to continue to see this unwind. They are taking it. You can see in the last week. See where we are here. So there's the November 4 close going into Friday when we were at 61% at 425. That would be a 50 basis point rate hike. And they're coming off on that, going from a 61, we're already down to 54. And on the other side of it, they're pricing in a 75 basis point rate hike. So this is going up, this is going down. We want to continue to see this smooth transition in probabilities, right? We don't want a lot of choppiness. We really don't want to see another bar show up on either side, right? Like a 25 basis point or 100 basis points. And that's what I've got for you guys. Be careful, be safe. It's all just hurry up and wait at this point. So try to avoid the chop. And I put a line in the sand for the SPX trades, right? I'm going to continue to hold my shorts as long as we don't get above. We'll use SPY for this. The levels that I wrote about, right? So kind of the line in the sand of being wrong would be if we get back above 390, then I'm absolutely wrong about the short and I'll get out of my entire short position at that point. But I put in a 50% mark and then the 100% mark. Just read through the blog post. You'll get it sorted out. See y'all tomorrow.